Right, good evening, guys. Ken at Tortoise Capital. This is the weekend strategy podcast for April 20th, 2024 for the closing on 4/19. So we're doing this Saturday morning. And let's start with the hybrid swing portfolio. So we're looking at 30-minute charts. And beginning with Alcoa. The yellow box represents 1 day's price action. The red box is the 5-day price action. The thick red line represents the 5-day anchored VWAP. This green line represents the 3-day anchored VWAP, so you get a sense of slower and faster VWAP status. This orange line represents the intraday only VWAP. So for those of you keeping score at home. All right, so we had a close here, an open here, no gap. This thing ran all the way up. I missed that trade. When this peaked and then crossed the 5-period anchored VWAP, I got short because we were a standard risk box off the top and it was failing, and it's been that kind of market. So this has been my standard play. It sold off all the way to the low and reversed all the way back up. And I exited at the skin of the dragon, so I captured that little piece for about 1R out of about a 3R potential. So I'm actually pretty happy with 33% efficiency. That feels sustainable. AI, this was a harsh sell-off, gapped all the way down to here, sold off, reversed. I put the risk box on. This is a morning hook. It ran all the way up to here and started to fail back to the edge of the dragon. I took that. That might be 1.5R. I missed this afternoon. After this compression, I missed that breakdown in the afternoon. There were other things failing bigger and faster. Caterpillar, this one gapped up, sold off immediately, and then was horrible all the way through to lunch where it rebounded. I took the 1-2 exit in order to preserve about 4R. Cliff, same trade for an R. You're going to see a lot of that today. CVS was a COTA 2. It reversed here, broke out above the peaks of the RL10. So I'm long. Here's where the R10 rolls over. I take the exit at the skin of the dragon right here. And that collects 1R. Skin of the dragon turns out to be my favorite exit these days. DIA, I couldn't find a way to get in this on the 30-minute. There were other things moving further and faster, which got my attention. Sell off in Disney. There was the close. Here was the gap down reversal. I tried long. It came back. I scratched. I missed the afternoon rebound, but it was there. Devon Energy, this was a gap and go. It hit the 5-period anchored VWAP, rolled over. I got short when it crossed below there, one risk box off the top. It droned along, held support along the Bollinger Band main, and I cashed one. Emerging markets, no trade. Ethereum, I had an afternoon opportunity on a COTA 2, which gave a fraction, not much there. EWW, this was a classic SSC, supported spring crossing, huge sell-off, terminates in a low in a harsh winter. PSAR flip reversal here, and the R10 is moving, and it cashes 1R by the end of the day. More to follow. And now this offers opportunities for a return to the 5-day, to the 150-day, and the 30-day anchored VWAP. It could even get back to the 5-day high, which would be nice. A return to 67.80 in Mexico. And so that has a long way to go. It's sold off pretty hard from the 30 period, the 30-day anchored VWAP. So that looks like a potential move of 5. That's a 5% move from 65 to 67.5. And with a small risk, that offers a lot of opportunities in the future. You can see what that looks like from here. This was the decay. This is when price was at the 30 period and it dropped this far. And it took that long to get there. So maybe this is, the theory is that's the first step in a recovery of maybe 3 legs up. So I'm hypothesizing that could very well be a swing low, and we'll be ready to play EWW as a high priority on the way back up. On the other hand, if this just fails through 64.30, I'm instantly short because now it looks like just a continuation of that longer term sell-off. So this is what a compound critical state looks like. Strong moves in either direction. And there's enough buying interest in here that made it come out of the winter into the spring outside of the Red River. It's not summertime until it gets above that 0 line, but this is what an early spring looks like. And I'd like to see some continuation early on Monday. Brazil is the second day into that, and it had a breakout, an emerging dragon, crossed the 5-period anchored VWAP, and we collected an R after it returned back to the VWAP after peaking right here. That was enough. Home Depot, no trade. Intel, I tried it short twice for a fraction this time. This is part of the continuing sell-off in Intel. It just gapped down. Tried that. The rebound allowed me to only keep a small fraction. It then rolled over. So I got short at the same level here that I did there with the same risk. And this one paid off a little bit more. I didn't want to hold that overnight, so we took that little fraction, and this fraction maybe squeezed some juice out of that for an R. IP, I tried short on the collapse. It reversed quickly for a scratch and then went nowhere. This feels like it's trying to set up a nice little bottom in here. Notice how the VWAP is anchored and the 3-period VWAP is agreement right here. Now you got a nice stepping stone to the upside. This is failure to fail. It's supposed to fail further to be in line with this. It didn't, and it's trying to put a bottom in. So I'll be ready to play that to the long side or a resumption to the downside. And that range is so tight that that makes a very small risk box for a very large reward opportunity. IP is in that mode. IYR, tried the short. It really didn't pay off much. In real estate, Coca-Cola, on the other hand, was the trade of the day. It was a gap up, continued to go through the 150-day anchored VWAP. And this is part of that 1, 2, 3. The third day of momentum was a gap up and go. So we got the standard entry with a standard risk, and it just exploded. When this did not fail further, second position, and then just rode them both up into here. It peaked at the 5-day high and made a new 5-day high and started to fail. So that looked pretty good to cash 6R on this one. and 4R on that one. That's about an intraday 10R move, and that will feed the bulldog, and we'll be ready for that some more. All it did was get back to the 30-day anchored VWAP after having failed this far away. So the same energy that made it fail this far simply recovered and beyond a little bit. So maybe there's more buying pressure. That's what the start of that looks like. We'll see. But that was a pretty good series this week. Regional banks, same thing. Came out of the sideways quiet channel where it did not fail any further, and simply got back to where it had come from. Here's the breakout on the Nakata 2, standard risk. This thing explodes to here. It peaks right here. And as this fails back to the skin of the dragon, just take my little exit right there. 1, 2, 3, 4. And that's what 4R intraday looks like coming out of the sideways quiet channel. We'll take it. McDonald's, Gap and Go, Emerging Dragon went nowhere for a scratch. 3M tried the short on the rollover. It was initially successful, and on this immediate sell-off down to the 5-period VWAP, the 3-day VWAP, the Bollinger Band mean, and I was hoping for a return to these price levels. All it did was immediately reverse sharply, so I just scratched. Nothing ventured, nothing gained. Merck, fractional gain on a Prada 2. Microsoft, the short is continuing, and I'm just taking a little bite out of crime here in the middle with a couple R as this broke down to a new low, gap down and drop. So tight risk box, sold off. Here's where it peaks. Come back to the edge of the dragon, collect 1 or 2R depending on how your slippage hit. Marijuana, tried the short, recovered for a scratch. I thought about this one, didn't play it, and then it collapsed really hard into the close. And you had to be right on that one to get it. But MSOS is a trading vehicle of choice, and it was just so late in the afternoon, I didn't have the energy level to get that one. Nike, rolled over short for an R, and it stalled. Nvidia, this is the trade of the day in the other direction, has been slowly and steadily selling off. Today was a gap down and continued to drop, so I speculated short with a standard risk. It mucked around and then began to collapse in a hurry. That was already at 2R, so I put a 2R battle drill on it. It sold off hard, and then I just want to collect that one. So this first one gets 7, and the second one gets 5, and I'll take 12R out, close up shop, and have no overnight over the weekend risk. And I'll be ready for that one next week, because now we have a considerable move from 890 all the way down to 760. That's minus $130 on, call it 900. Dude, that's about a 15% sell-off from here to there in the AI winner in Nvidia. That is going to have people salivating. So I'm ready for that thing to recover or to truly collapse. And I'll just wait for next week to see which way price wants to go. I don't care, don't have an opinion. Not emotionally connected to it. Clean energy, this is another one of the high volatility traders. That was yesterday. This is a continuation, same trade on a collapsing dragon for about half an hour, no overnight risk. Palantir, same trade for an hour. Rivian, same trade for half an hour. SOUN, Now, this one was one where I used a little discretion. It was a collapsing dragon. That's clear. Sold off hard to here. It was coming back this way. It was approaching the VWAP, but didn't quite hit it. And the R10 hadn't peaked yet. So I had my finger on the trigger, and instead of breaking through, which where I would have exited, this thing rolled over and gave me another little leg down, and it was close to the end of the day. So I collected 1R and was happy. I was hoping for more of a collapse. The S&P was pretty much just a straight slide, and nobody wanted to hold this market over the weekend. That's going to start tipping the scales to the value seekers at some point. Treasuries had a slightly improved day. Tesla, the slide continued, and I collected an R. Walmart. This is an SSC intraday. Here's the bottom of that R10, and it rolls up and gets up to the PSAR. So I just speculated in what the heck. It ran up, came back, collected 0.5. I was pretty happy with that. And I'm looking for this one now to maybe next week come back to the 30-day and the 5-day and the 3-day anchored VWAP. So that's what that next progression up would look like. If it starts failing, I'll be short quickly because it's easy to believe in the downside as this market leadership continues to slide. Excuse me. U.S. Steel, bite-sized half an R on a continuation. Same thing with XLI, about an R on a continued rollover. That's a COTA 2 to the downside. You know, it gapped up, rolled over, comes back through the Bollinger Band main, the VWAP and the 3-day VWAP. In this market, that's an auto short for me. We'll take a quick look at some sniper trades of the day. These are all on 3-minute charts. This is what that Coca-Cola long side trade of the day looks like on 3 minutes, where I'm getting additional positions on, here's the gap up, and then the breakout starts, standard intraday risk, first leg, finds support, breaks through the dragon, PSAR flip. That's a COTA 2 all day. Grinding, and then an emerging dragon breakout for a nice trade. So this is about an R. This one's about 3. That one's about 1. That's an additional 5 intraday to the 10 that the swing trade picked up with those large positions. So that was a good day in Coca-Cola. This one is slow to fill. Come on. So this is the slow grind in Nvidia. Yesterday's close, little triangle formation, then a collapsing dragon breakdown, standard risk, collect. It peaks and rolls over before it gets to the VWAP, so that's an auto short scratch, auto reentry, half an R, another COTA 2. This one collapses hard, so second position, and then an exit near the end of the day. And so we're collecting probably 1, 0, 1, 3, an additional 5. Let's take a look at the traders from Friday. See how the boys did. Tim brings home 2.1 in AMD. Here was the close. Here's the open. It oscillates. Here's the collapsing dragon for 0.3. It rolls over, bounces off the VWAP. Notice how consistently important that is. So he gets the re-entry short on a collapsing dragon, VWAP rejection, a bearish kata 2 with a downward sloping VWAP. That's automatic, friends. This could have been a second entry, and this is an automatic exit, 2.1. No overnight risk. Perfectly played. Here is Brian. Ends up, I think, yeah, comes out with about a 0.4 day and gets this first one. Let's see where and exits somewhere in here. I think I'm having a hard time seeing that. Oh, okay. I'm sorry. There's the exit. Yeah. And then this one, I guess, recovers to here. There's an opportunity here on the support. Yeah. Oh, okay. I see. He's using these to indicate different elements of the indicators for price relative, right? So here's the 270, there's the 90, the lower skin, the spine, and the upper skin of the dragon. So he's getting a sense of the targets and distances. So he's working on his dashboard in here. Here's from the previous day, some SFCs and a kata 2. So this was the natural kata 2. And maybe, he's looking to get an earlier, he wants to cash this one for a win as it starts to stall. Understandable. He gets this one, that collapse. And I can't see, that's his wrist box. And I think, yeah, I just can't see, Brian, where your exit is on this one. So if you can help me out in the future on that one. And then here's the breakout from a compressed there really wasn't a lot of movement in the Kiwi Friday. So he got what was there. George? All right, let's see. So he's working on, 30-minute chart. This is XLI. This has become our new S&P sector of choice, the industrials. And now notice we got this long downward slide with these lower highs. And so this one starts off the day. Here's the close. It opens here. It runs all the way up, peaks at the PSAR, and then starts to fail through the Bollinger Band mean, the skin of the dragon, and the VWAP. So now he's taken that short with a standard risk box, and the thing collapses nicely and then starts to reverse. He says, whoa, let me cash that one and make 0.7. At one point, that was probably up to 1.5, maybe even 2 are in hand. So he does get 0.7 out of it, and that's good management. Gets a fraction on this one for 0.1 in Coinbase. There just wasn't much there, but he got what was available. Notice again how that gap up and then hits the PSAR and doesn't break out, but starts to roll over. Here's where it crosses the VWAP and enters the dragon. So if we use the same technique on this one as we did last one, we probably could get short here instead of here. Now, if you had gotten short here and it rolled off this far, you'd probably end up exiting somewhere in here to preserve that. And then you'd have to re-enter here in order to get that. So there was some movement inside here, but that intraday oscillation was large enough to make that harder in practice than it might otherwise appear. If you go to a 10-minute, you'll see how manageable that actually is on a slightly faster time frame. He gets a fractional loss here on IP, does not take the re-entry short, which would have paid off and gotten him to net zero. That short could have happened, anywhere in here, but that's so the potential was there, but I don't blame that. That's running out of time. He's able to get a fraction Rivian. So this is one where it has the gap, it runs way up, and then can't break out of the dragon. And sort of he gets that inside curl and gets short when it breaks down here. The wide protective stop allows him to absorb the heat a little bit. And then it moves in his entry, moves in his favor, I should say. Then the rebound, I think you're slow to take that exit there. I got to think that somewhere as this is coming up, you want to start preserving half of that exaggerated move. That if you get a sharp down and then a sharp up, I just kind of keep half. And that might help improve the stats a little bit on there. He saw that as an opportunity to the short side. It would have paid off. He was running out of time, so that's understandable as well. This is my brother. Let's see what he's got up for us. So he gets sloppy and lucky on this one. Don't make it a habit. He gets short in the usual way on a decay. So he's short here. It rolls in his favor. He comes back up probably to, I think, too far. But, you know, he's never underwater. That's just, you almost have to get out of that at this level. If you don't, if you do get out, you could probably re-enter here. So it's not that sloppy. But the next time when he allows it to regain the same depths that it did before, this time he's quicker to cash. And the mistake here is he didn't have that stop loss. This should have been out right here, I think. And then if this gets to here and starts to reverse, I think you could re-enter there and not have to eat that heat. And then you get that second leg down, I think is, so he was given 2.3 that he did not earn, he just received. So we'll take that. You know, good things happen to bad people, my brother, so don't worry about it. Now, what he's doing properly is this is the Nvidia intraday trade, which you saw me as the trade of the day, but he doubles my performance because he's using the automatic 2R battle drill twice, and then he gets to here, and now he's holding 21R, and that ain't bad. Now, that's a good problem to have. How much of that do you keep on the short side? What he's done, I think, is put his stop here. The only concern I have is a gap up on 3 positions. I might keep 21 and then sell 2, keep the 1 in place so I have 1/3 of my position overnight. Then if there's a gap, it doesn't hurt me. But if there's a gap in the other direction, I lose that on 2 pieces. But now I can put those 2 pieces right back on. And that's a way to sort of manage it. I just am afraid that Nvidia being such a magnet for attention and being down 15% from in the last 30 days is going to attract a lot of potential buying on the dip at the open, which could trigger a gap up. So I'm just a little concerned about that one. Schmuckers. So this one is a 30-minute chart. And this is the, the sell-off to the extreme low. And now here's the first breakout, which breaks above all of this. This is all failure to fail further. It does not fail further. And you've got a Z3 compression. Nice, tight, sideways, quiet channel. So what you do is you bracket that, and you say if it breaks below whatever that is, 109, I'm going to be short because of the power of this sell-off. And it had 5 days to break out, but it didn't. So I'm going to be ready to go short on a continuation. But that same 4-day sideways compression not only is failure to fail, it's failure to follow through. And that means that pressure is building up inside the steam kettle. And whenever the breakout does occur and you don't know the direction, you just say, well, I'll go long if it's that way. I'll go short if it's that way. In this case, it breaks out. And now he's using the automatic 2-hour battle drill. And he's got a massive first day gain. And again, you could sell 80% of that and keep 1/5 for the long haul. But this is what a 5-day down range compression and then a breakout looks like. So stay with them. Classic 5-day down. And then it can take 2 or 3 days for that thing to finally unfold. In case it took 4 days, so be it. The tighter the compression, the more balanced the pressure is on either side, and it's building up, and then the breakout goes in your favor. So this is how you play that breakout on the first day, and then you use that to raise some cash intraday with a really tight position, and then maybe you keep one of those with a wider stop down here as a swing trade. And then the next day on Monday, if this starts going up, you take that 80% of capital that it earned and you start putting that right back to work intraday, because you can get those kinds of directional days, especially since all we have is 1 day of large directional move after a long period of breakout. And there will be some people that said, well, it can move that far Monday and that far Tuesday, and it gets up to here, and it's just getting back to what the previous fair value was. So you can cash a lot of wins here, keep a piece in case of a gap, add it back in if it continues to work in your favor, and you might get 3 soldiers marching is the, you know, is the candlestick description of that. And now you get day 1, day 2, and day 3 momentum. So you can use hybrid swing trading to your advantage there. And that's kind of what he got here, showing it a little bit easier. He liked when it had broken out of the above this last short signal. And you can see that he was trading this thing on the short side with standard gap down, second position, cash, chop, breaks down, collapsing dragon, second position, cash, re-entered short for a scratch. Now here's a collapsing dragon. He doesn't get until here. That's fine. 2-hour battle drill, covered. And now nothing. No breakouts. Pressure building. Pressure explodes. He gets in. 2-hour, 4-hour cash. Raise a lot of capital. That's what that looks like. That's in the advanced hybrid trading course, which we're taking applications for. I would strongly urge you to consider coaching with my brother on that one. He does a great job of explaining how he does this. Now, he's a supervisory emergency room and hospice nurse, so he picks windows of opportunity and targets in compound critical states to focus in at critical times, and he uses alerts to tell him when it's time to come pay attention for these targeted opportunities. If you're interested in finding out how he does that in his off-duty hours, give him a call and send me an email. I'll connect you. There's a limited amount of slots that he can do that with, but you'll be glad you did. Let's look at the traders. Oh, the other traders. Let's see. I think was there anybody else? No, that's it. Let's take a look at the reports then. All right, let's take a look at the weekend report now. And what we have is still bullish volatile, but now we've come down from overbought into high neutral on the annual. So we've come back quite a bit. So we're just above average right now on the long term, and we're deep in the depression here of oversold. We're yellow bullish. This is actually a tipping to the bullish side, or the bearish side, I should say. We're in volatile volatility, and the risk Z is showing risk off abnormal volatility. We're right at the place where we could have a big price collapse or a sudden buying frenzy to get back to previous highs. We are at a compound critical state for volatility short term. The ETF2 market, which is pretty risk averse, that system, this week went from 70% to 10% allocation because now 9 of the 10 broad regional indexes of the world are below their 4-month moving average. Only the S&P is above its 4-month moving average. Everything else is below. Last week, 7 out of 10 were above their 4 months. So this was a tipping point week where everything began to significantly crash. I wouldn't say crash, but went off the rails. That's a better characterization. And that's what that looks like using just the 4 regression lines. So you got notice you have the 270, which has this nice run up to that peak. And its little momentum is starting to stall, and it's coming into the potential down. The 90 peaked right about here. The 30 peaked right here. And that's why it's such a good barometer for the health of the current market. When the 30 rolls over, that gives you an owl alert that the downside can be happening. And that corresponds with this. This is where it went into the winter, which is right here when it crosses the 270. So just notice that when the 10 crosses the 270, you have the end of what began way back here. This is where the 10, that's the thin line, crossed above the 270. From a maximum excursion away to here, it recovered all the way to here, and that's fine. That's what the spring looks like. Here's where that summer begins. That summer lasted all the way over till now, this week. Yeah, were there some oscillations in there? Sure. But notice that it has been a steady climb. That steady climb is reflected in the slower, less noisy 90, but that thing sort of peaks when the 30 rolls over. Alert, 90 rolls over, confirmation. When it crosses the 270, absolute certainty that that's done. And now that's at about a price level of 508. And we're now at 495. That actually gave you a $15 cushion from where that exit could have been taken down to here, which gives you about a 3% improvement instead of waiting for, the confirmation on a Friday and the week over week that, oh yeah, this is now back. Could have saved 3% there. That's almost where it comes out. This is where it comes out of the river. Now it's getting significant. This is where it crosses below the 0 line. And now we are in the winter. Next support level, this big cluster over here at 470. Hey, from 495 to 470, that's another minus $25. So don't discount that. We've gone from 525 to 495. That's minus 30. A move right back here to 470 is only another leg of what we just saw. We're almost through this little buffer. Notice that at critical times when this gets around the 0 line and it goes from winter to spring and is now thinking about summer, that 30-period Bollinger Band on the 270 gets to be very narrow. The very narrowness of it tells you that this is a long-term critical state. Then when it breaks out to the upside, all the conditions for a long growing season are in. And as that continues to do well and the 270 is climbing, the 30-period Bollinger Band on the 270 gets wider and wider, and that's like a buffer. That's what's in the warehouse protecting you. When this rolls over, that's how much slack you have, and now you're cutting into long-term storage, and it's almost ready for panic. This is cutting to the bone. This is like your superficial fat. This is your long-term protection and buffer. And that's confirmation that we're on the edge of danger. Now, the edge of danger is a compound critical state. Why? Well, because that is from 525 to 495, that's minus $30 on 525. That's about an 8% sell-off. At 10% of people, well, that's officially a correction, but a 10% sell-off these days feels like the beginning of a bear, which isn't really a bear until it gets, 20% off of 525 is down around here. That's where it would be officially a bear. But the reason they define 20% sell-off as a bear is so that the retail trader doesn't panic and pull their money out of their mutual funds, which is bad for the professional money managers, until it's 20%. Because they don't actually think there's going to be a 20% sell-off, and they don't mind if you suffer those losses as long as you keep the money under management. So in their mind, they got to treat 10% as an operational bear so that they can take action to start trying to recover it. So we are right on the boundary here of pro money managers starting to panic, because they know that if real panic comes in, it drops to here, and then it's the beginning of a bear. So they treat that professionally as the beginning of a bear, which is why I treat the 270 as my target for taking protective action. So the RL10 crossed the 270 here. It got this far to the maximum excursion from the 270. That's how far up it went. It could go that far below and be within the same amount of power. If you call it, I think of it as how much power did the traders have to take it from the 270 to the peak? That's how much power they had. So I just clone that to the downside and say, yeah, 470 is in range, and we're already at 495. That's only another $25. Whereas this was $30. So that's where we are. This is where panic genuinely sets in. Why? Because that's connected to this. This is the excess surprising gain. Like, if this market had just gone from here and did this leg and then monkeyed around and did that, everybody would have been happy. That's the sort of normal glide path. But what it did was had an exceptional 4 sigma move up to here. So now everybody is looking at this as well. I can still preserve this much. I couldn't expect to hold on to the abnormal gains, but now they're really concerned, having given back 2 scoops, they only get 1 scoop left. So there's an urge to protect that. That's how I interpret this market psychologically. On the edge of thin ice in the spring, walking across a frozen lake with real concerns about, am I able to get past it? And then you say, what happens now between here and November? Well, I got the 2 idiots running for president, Donald J. Trump, soon to be felon, the amnesiac Joe Biden, Jesus, thanks. And then the wild card of RFK Jr. and a razor thin margin in Congress and disaster, plus on the above, I got Gaza and the entire Israeli-Palestine connection. Holy smokes. Is that the kind of foundation that's going to make it easy to find reasons to believe that this is a support level and that normal is just going to do that and go? No. There's so much uncertainty in both international and global politics and the ever-present debt. Ugh. And China, Russia, Ukraine, we haven't even talked about that. Is that the kind of geopolitical that's likely to produce? Well, I don't know. There's no direct cause and effect, or we'd always know. And so maybe the fact that it doesn't seem likely is what could cause that. I don't know. Not going to be much new legislation coming out of Congress. That's the one positive thing I see. And there's going to be a lot of short-term boosts that will make the economy look good for the current administration. So there's room for growth tactically. It's hard to see how it gets above here until after the election. So this is going to be tactical trading for the next 6 months, fellas. This is tactical trading, and you would be well served to get it while you can. If you see short-term opportunities for a little rebound and it starts to stall from here, like if that's what it did, it came out of this and started to gain and then stalled, you better cash that and lock that away and put it in your storehouse. And just expect between now and November that you're going to be engaged in a series of short, careful, measured steps to try to pick up pieces as you go. This is kind of a coyote market. Extremely opportunistic, very hard to trap and fool, is quick to grab and go what you can. A bird in the hand is worth two in the bush. That's my psychological state going forward. Coyote style market. On the 3-day, I just want to show you some things that now I'm looking at the 3-day. That's fast, and the 9-day is slow. Each bar is 3 days. Look how good the PSAR on the 3-day was. It got you in at the PSAR flip here before it even went to summer. And it could get you out. If you got here at the bottom of the dragon and the PSAR flip, you're getting out at 515. The Bollinger Band mean here is at 498, and it's slightly below there. So the 3-day lower skin of the dragon or the PSAR or the Bollinger Band mean give you realistic ways of managing successful long-term trades once the peak is achieved. You could even be aggressive with that and say that I'm going to be long as the slope of the RL10 is up, and when it peaks here, I accelerate to this upper skin of the dragon, and you get out at 520 after a nice, really long run. You don't get out over here because the slope of the 10 is good. It took that long for the slope of the 10 to peak and reverse. I just actually think it's realistic to say, look, when the R10 peaks and when you get the RL10 cross the dragon, or I'm sorry, cross the 30, that's a P1. Then make sure you don't give back anything more than the PSAR. That seems to me to be the right way to be using the 3-day. And then you could even have a short orientation here. Now, I've had a short orientation on the intraday trades. Now, what makes it even a little clearer to see is when you use the 9-day bars, and now you can take the peak of the RL10, which happened 15 or 18 days ago, and now suddenly you can take the skin of the dragon and get out at, this is about 510. The bottom of the dragon, we haven't quite reached yet. So to me, the 9-day bar, it's too slow for the PSAR, but the PSAR flip is where you are absolutely short. I think the combination of looking at the 3-day for accelerated exit on abnormal gains is the right way to go. The 3-day PSAR is extremely powerful. And then the 9-day PSAR flip is a powerful short signal for the longer term positions, because it would not be surprising to see it come all the way back to here. Now, this becomes the next crucial support level on the long term, because anything below here is a raging bear. But any recoveries from here become Kata 2s. So if it sells off to here and then starts to recover from here, that's a Kata 2 because you have a higher support. So the 9-day gives you a chance to detect when the longer term guys have picked up enough confidence that they're starting to buy it, and you would see the 9 days start to rise. So those are opportunities for Kata 2s until you get back to about 450. And then that is pure collapsing dragon on the 9-day. So I look at this every week as a way to step back from my intraday and my shorter term swing trading to start getting a sense of the larger market mosaic and where the key price levels are. And then you'll notice this is all the same standard patterns. They are fractal on the 3-day and the 9-day. They don't change that much day to day, but every 3 days or so, I like looking at those. This is a daily chart with a 150-day look back, which is part of the sniper framework, So you can see there's the 150-day high, all-time high, 150-day low. That sets up this as the bracket. So in the sniper trading, we set that equal to 100, that equal to a 0, and then the top 10% of that is when it's at exceptionally overbought. So this was a fireworks right here. Is it going to fail? It turns out it did, but it could have also exploded that way. The other end of that is when you're down in this region in the bottom 10%, and these are the Godzillas, and that's the breakout that created an entire Godzilla move of 5 months of Godzillas with Kata 2s all the way up. But now we're had boom fireworks, and now here's the collapse. Now we're in a critical state. It's now lucrative to think about a rebound, a buy on dip opportunity that takes us to here, or a collapse which takes us to here. That makes this a very tight compound critical state, and it's so close to the 500 psychological price level. You could see how people would be willing to risk $5 here on a breakout above 500, hoping to get to 525 with a $5 risk. That would give you a 5-to-1 to the upside. Hey, that's a significant issue. And you'll see in the daily report how all of the channeling and overreaction signals in the big indexes are all firing a long signal to automatically take that. Because statistically speaking, that's a high payoff trade probability. There's a lot of people that believe in this because there's nowhere else in the world to park a ton of money. All of the other indexes in the global markets are much worse. So I have less confidence in them. That's why the S&P is the only index out of the top 10 that are above its 4-month moving average. That's where any residual strength is. So if you're a money manager and you got to put money to work in equities, which market are you going to pick? Well, I have some plausible deniability to say, look, I was buying the strongest market on sale, the only one that had any hope of rebound. Who's to blame? That's the best. That's what a fiduciary would do. If I'm obligated by the terms of my mutual fund or my ETF or my pension fund to have a certain percentage of my money at work, Where else but the S&P and the US are you going to have it put to work? So that's the argument for the upside trade, which is a 5-to-1. I've already made the case why if this thing collapses, it's like thin ice, and it's an easy 5-to-1 trade on the downside just to get to here. And if that cracks at the RL 270, the next one is all the way down to here. And that's what exactly that looked like. This used to be, that was a 20% sell-off that took us down to this level at 420. And that was where we were really looking at the same thing here that we are over here, and that is a compound critical state, which could go large in either direction. It turned out that not only did it go large, it went huge, catching everybody by surprise. That was a 4 standard deviation surprising move, which we've been tracking every day on the Z-score of the RL90. That's how that one tells us about the probabilistic nature of how unusual is that move. It was 4 sigma unusual. So now in this location, we have the same circumstances as we had back here, which is a compound critical state, strong move in either direction is possible, 5-to-1 short term. And then if either one of those are successful, the second leg up is an even bigger, stronger move because now it's above the all-time previous high. So if it can actually get above 525, and that's only 5% or 8% away, this thing could be a long-term and a recovery of resumption of the U.S. strength. Or if it breaks through this, you can see how there's another minus 10 to 15% just to get back to the baseline. And that's where they would officially declare it a bear market. And then you could have a third leg down. That's what happened in COVID, by the way. This is only 8%. That's 15%. That would be 30%. COVID took us down to 40%. So you can see how the implications for what happens out of this very important intersection of buyers versus sellers, rational thinkers versus fear mongers, intellectual decision making versus emotional fight or flight response. All of that is going to be on display as we come out of there, out of this round number around 500. That's what we're looking at in this market for the next 5 to 6 months, in my opinion, or my description. This is what that harsh move downward looks like. This was the all-time high, friends. Just this far back. This is 10 days ago. That's 15 days ago. 15 days ago, we were at all-time highs, and what could possibly go wrong? Oh, how about an 8% move that went through the end of summer into the fall, warning, crossing the Bollinger Band mean at 515. That's where the exit were indicated on the 3-day. And even if you use the Bollinger Band mean to orient your brain, and now this has been the short side opportunities of the last 10 days, of the last 5 days, and this thing is closed at the bottom of a large 5-day range, at the bottom of a large 10-day range. That's what the sniper salivates over. So now what am I looking at? I'm looking at a nice tight risk box around Friday's close, and I'm ready to play the rebound for all the reasons that I've talked about, and I'm ready to go short for all the reasons that I talked about, and I have 0% overnight risk, because that is the definition of a zero state with no directional bias, but my bias is towards, a large explosive move is coming, and I don't know what direction it is. So since I have no directional bias, I can just put that in a lockbox and be ready to go either direction. Let's go. Trader's delight. And that's what the 5-day 30-minute bars look like. And now let's look at the anchored VWAPs. And where are they? Here's the 30-day, here's the 10-day, here's the 5-day, and here's the 3-day, and price is well below all of that and decisively down. So if it goes below 494 Monday, what you gonna do? It's getting ready to come out of the Red River. That is only the beginning of an enraged downward move. This has been an orderly sell-off. Now we're down 8%. Not even officially a correction yet. They'll start calling it a correction when it gets down below about 490. So there's a slight little gap of about $4 more in here for them to monkey around and then recover. That's where the morning hook could be. It could sell off a couple bucks gap down from everybody that's panicking over the weekend. And then that becomes the springboard for their nice 10% recovery, which would be 3 legs of 3% to get it just back to the 30-day anchored VWAP. That would be a victory. It would be a major victory to get it above the all-time high, and off we go. The all-time high is not even, it's at 525. So any collapse short and then measured rebounds on the way up, which would be very cautious because of the inherent danger of all the indicators flashing red. That's what blood in the street is potentially looking like. I'll leave the rest of these for you to take a look at. What was working? Nothing. Diamonds were the least worst. That's why the Dow 30, DIA, is such a great trading vehicle because it resists the sell-off because of the protective value of those market leaders. Financials actually had a little bonus. Utilities, defensive play. Consumer staples, buying what people must have. What got murdered? Oh, technology got slaughtered. And the S&P technology was much worse. That tells you the large cap tech companies that exist in XLK, like Cisco, Oracle, IBM, Microsoft, Apple, Google, Amazon, those guys all got, Nvidia, all got slaughtered. Consumer discretionary got slaughtered. Tesla, Home Depot, and Amazon are in that. They're as bad as can be. There's my boy, XLI, industrials. That part of DIA is the one that's given it any kind of strength. You know, that's where you're seeing some elements of DIA. So if you look at inside DIA as the strongest index, you could take a look. Energy is such a cyclic one. That's, yeah. But XLF is at the top pulling up. I is a little bit behind it, stabilizing or trying to pull it up. XLK is just getting slaughtered. Materials are not quite as good as industrials. Utilities are up here as a defensive play. But the problem with utilities is that they're never going to be the growth thing. As soon as it looked like the ship of state reverses, that money would come flowing out of utilities and into the whoever the leaders are. That's how that works. Healthcare wasn't so bad, but it's been getting slaughtered. Technology is what's really getting punished here. Discretionary, also bad. Okay. So that's how you can read that to start seeing the patterns and trends inside the packing list. When you add some of the narrowly focused sector ETFs and some of the globals. Now you get things like silver, agriculture, and gold. This is the one that I could just shoot myself in the face for not doing a better job of catching that move earlier. I had this thing as a value play on inflation from about 20 to 22, and I was happy with the 10%. And so I cashed that win, and then I just completely missed the move to almost 27. So I captured two, but I missed three because I didn't stay with it. And it was like corn growing. It was so quiet. I just didn't notice it. Clean energy. That's why it's on my list. Every time that thing shows intraday weakness, I am pounding that thing to the downside because it has a lot of volume, a lot of intraday range volatility, and the long-term trend is so bad that there's nobody that wants to buy that. Nobody believes in clean energy until they see who the new administration is going to be in November, and are they going to take taxpayer dollars and throw it at clean energy as part of some Green New Deal. You can guarantee that'll happen if the Democrats are in play. So the more that it looks like Biden and the Democrats taking over the House, ugh, that's the signal that this thing might work. And meanwhile, it's getting murdered. You know what that's setting up is that if you get Biden and the Democrats, now suddenly all those things are going to be on sale. And then you start putting in a bunch of government money from the printing press. That's what'll be the turning point in clean energy. Brazil has suffered enough that maybe it's ready to oscillate because it's not the US. You never know. Inside the Dow 30, we saw the strength in financials and XLF. American Express at the top is pulling XLF north. Goldman Sachs pulling XLF north. JP Morgan pulling it north. That has more room to go. Travelers. So those are the two losers in XLF, and those are the two winners. So what does that tell us as a strategy? If I had XLF, which is outperforming, if XLF starts to fail, who are the most likely candidates to suffer? Well, I could say Morgan and Travelers are likely to fail because they were never that strong to begin with. Or I could say American Express and Goldman Sachs could fail because they have so much more gains to protect. But once XLF fails, all four of those are going to get slaughtered. And Visa is even worse than those other two. And now we talked about how XLK is getting slaughtered. Intel. That's why that's been on my short-term intraday trading list because that's just, it can't go down fast enough. And Apple, horrible. Microsoft had been better, but even Microsoft has not been immune to the punishment, and it got murdered this week. IBM, not quite as bad. It's not as big a player anymore as those other three. So I want you to see how some of this market sector target, market sector company target, you can start seeing this as a giant influence diagram with 50% of the directionality coming from the market, 25% from the sector, and 25% from the company. You don't have to go very far down the rabbit hole to find some good ideas in there. Looking at ETF Max, the ones that have, the top 150 by liquidity. Now, not only is gold good, but man, gold miners are even better. Here's gold. The gold miners add some even tighter focus and some company volatility to give you better benefits. But maybe that's already done. Silver's already had its run. And that's my concern. But that's why you got to remember that this painful sell-off of 8% has now set up a lot of people that are just now getting hungry to start buying. So all the ones that have had big payoffs, if they stop leading, then there's going to be sellers emerge pretty quick to protect the gains. And that can look how fast this market changed from all-time highs to this 8% sell-off in 15 days. So be mindful. On the other end of the spectrum, way down at the bottom of the ETF stack, these are all the things that are horrible. Is that the first sign of a little bit of recovery in UNG, or is that just automatic value buyers taking a short-term gain? I like this one as EWZ as a favored trading vehicle, and its bias is down. So this could be a long-term SSC, etc. But in terms of just how bad PBW is, the clean energy, it's 183rd worst out of 185. And it's one of the top 3 or 5 based on intraday tradability. So that's why it's always on my short list for intraday trading and not just swing trading. I'm starting to ramble a little bit here, but there we are. Everything is weakening. Mid caps, S&P, European large caps, Euro Asia large caps are the only place where there's any strength. Treasuries and real estate are just there's no safety there. If you thought those were a flight to quality, you'd be wrong. So be careful what you think are the cause and effect rules and what diversification means. Standard work. This is that recent strength here in energy. But that's so cyclic. That's not a long-term play. That's cyclic in nature, driven by geopolitics and price of oil. Gold is already at an all-time high. You wonder how much more room there can be. Silver just smashing everything. Standard work here of the most liquid 30 ETFs and showing their tradability based on how routinely volatile they're. Like, those are hard to trade unless you're using futures and a lot of leverage because they just don't move that much intraday. But semiconductors sure trade nicely, as does gold miners, as do biotech and silver, as does Brazil. Me gusta. We saw that sniper trade of the day. We reviewed those already. Let's look at the Dow. So with that much of a sell-off, it's not surprising to see that many symbols on the auto framer. I then am drawn like a raccoon to shiny things for where are the big collapses occurring? Apple, Intel, Microsoft, Nvidia, Tesla, Texas Instruments. Are there any surprises why those things are getting us on? It's all your big cap tech. What's working? Where are guys going in the flight to safety? hamburger and a Coke. You can trust the American consumer. 10-day breakouts. Coke and McDonald's. That's why they're on my short list. Think back to where we were an hour and a half ago when you're taking a look at now the McDonald's intraday trades, while everything else is getting slaughtered. McDonald's has offered that. That was my attempt to get the next day momentum. I was hoping that this would happen here. I ended up scratching and missed that. And what does Coca-Cola do? Coca-Cola, it was Coke's day. It had a little gain off that bottom, and then did this, and then this was Friday. While the market was going towards panic, it's already above, it's back to its 30-day anchored VWAP and above and going. That's why it's on my list over here of tradables. Something's always working on that list. I don't need to go much wider or deeper than that. So this little quietude right in here says, shh, Coke and McDonald's, still room to go. Shh, Procter and Gamble, still room to go. So you could take a longer term look at those. If we did, what would that look like? With your permission, what if I just turn all this off and go take a look at the 3-day on Coke? We're nowhere near the upper limit of where that thing could go. In fact, that was the big sell. It just started to get back to normal. And this could at least get to here before it becomes even noticeable to other people. And then it goes to here. And then it goes to here. That's just routine climbing the rungs of a ladder. If it gets above, say, 65, long gone. What's McDonald's look like? Even better. Even better. This is only the first day off this horrendous sell-off. Oh, what's that look like? That looks like if you were short in here, and then that's where the R10 peaked, and it came back to the skin of the dragon, you would love to buy it there with a risk. This is 272, and that's a $6 risk. And what's the upside target? Probably here. 292. So that's a $20 gain on a $6 risk. That's a 3.5 to 1. If you're a great big fund manager and you got to park a bunch of money somewhere, and you say, look, McDonald's can go from here to here, and this is really just a cotta 2. It's a cotta 2 when it breaks above the PSAR, but I could front run that right there and be happy because I'm on a 3-day chart. And now I've got a nice upside move. Oh, and if it goes wrong, it's going to fail all the way back to here. And I've got a 3R move that way. Done in one. That's using fractal framework. That's using these charts to find targets that are in compound critical states and give me favorable moves in either direction, and how we can use statistics to frame the size of the risk box and so forth. I'm almost getting tired of hearing myself talk. The auto framer, standard work, buyer's market. Were there any squeezes? A few. Goldman Sachs, Cisco, Home Depot, and McDonald's is in a squeeze, the opposite of pain, and it's a 3 to 1 to the 10-day high. Oh my God, is that a no-brainer? If you're not trading McDonald's, I just don't know why. Here's your auto framer stats on my list of tradables. Those are the ones that I use every day for the hybrid swing. Home Depot is 8.5 to 1. Mexico is 6 to 1. Intel 3 to 1. Done. Here's all your winners. They're so close to the 10-day high that you don't get an auto framer, but that actually tells you who the winners are. They haven't even pulled back at all, or they've worked their way back to the 10-day high already. So depending which end of the pain do you want, you could say after a bull market that peaks here at a 10-day high, there's some that have sold off this far that now give you the auto framer the best ratio, or do you want the ones that already have worked back to the 10-day high and are ready to break out? Do you want this end of the curve or that end of the curve? If you want the value with the high reward to risk, you're up in here. Those have been the big losers. If you want the big winners that are already ready to break out to new highs, you're down at this end. So you decide which end of that curve you want. And oh, by the way, here's the big fat S&P right exactly in the middle at 3 to 1, like it always is, giving you the average, and then you can pick the outliers, because this is where the biggest follow-through moves are going to be. That's why I highlight the S&P in that stack every day. Dominated by the winter, no surprise. Huge reds across the board, but notice there's some green creeping in. American Express, Coke, Procter & Gamble, Goldman. That's where the little hidden strength is starting to slowly emerge. Latin America, energy, metals and mining. Ooh, Brazil. That's where that little SSC first starts to emerge. Doesn't mean it's going to work, but that's what it starts looking like. Whereas tech and the S&P absolutely getting slaughtered. A few pieces of light sneaking in. That's what Mr. Coyote in this market is looking for. Hard to pin him down. Targets that are both reliable and volatile: marijuana, Tesla, Nvidia, clean energy, Intel, CAT. That's everything for today. We'll get this published and posted. There's a little bit more lecture and demonstration than simple expeditious reading of the markets. Let me know if you found that helpful. You should become interested in the sniper trading course. That's another name for the advanced hybrid swing. Advanced hybrid trading. And you should strongly consider being coached by my brother. You might be interested in being coached by me. You still got a chance this week to sign up for the year-long coaching at the price that will never be repeated. It'll never be this inexpensive again. Take good care. I mean, that's like a year-long workshop with weekly check-ins with a group of people that are already skilled in this style of trading as your community of practice and trading partners. Man, that is setting you up for as much success as I can in this style of trading. I'm not saying it works for everybody, but if it resonates with you, you know what to do. Off to the soccer pitch.